Well, hello, Facebook Livers and those that are joining us on YouTube later, as we have been putting these up on YouTube after the fact, if you didn't know that. We will, Brandon, we should probably put a link to our YouTube channel, and we'll do that. But today we are here for IPB Live number 9. We're talking all about the reduced paid up option with whole life insurance. The reduced paid up option is something that exists. Oh, I should probably move over a little bit so that I'm in frame. But the reduced paid up option is something that exists in every whole life policy that I've ever seen. It's not something that you add on. It's typically something that's included. But I'm going to let Brandon tell you all about what it is and why anyone would ever consider using it.
Yeah. So the reduced paid up option is one of the non-forfeiture benefits that's pretty standard with all whole life contracts.
That's fancy. That's a fancy term.
Yeah. Non-forfeiture basically is an insurance term from almost, actually a century ago or more that speaks to the benefits that policyholders have that insurance companies cannot take away from them. So it's kind of like an element of building equity in the practice of paying premiums on a life insurance policy. And if you choose to cancel the contract, there are certain benefits that you get to take with you.
Right.
So reduced paid up is one of the non-forfeiture benefits. The other two are the option to extend a term insurance policy with the whole life policy. And the last one is take your cash. Right. So we're going to talk about the reduced paid up option. And I don't know that I could name a whole life product that doesn't have this as a standard benefit. At least not one that's been issued within the past couple of decades.
Right.
So
during the time in which we would have been actually in the life insurance business.
Yes. So what's technically happening with a reduced paid up option is the insurance company is going to look at the amount of cash value that exists inside the whole life product.
Right.
And they're going to calculate a guaranteed level of death benefit that can be sustained with that cash value for the remainder of the policy period. Policy period is simply, in today's terms, the insured's age 120 minus the insured's current age. That is the remainder of the policy period. For older life insurance, whole life insurance products, age 100 may be the maturity date. Age 90 on some much older whole life products. So if you have a much older whole life insurance policy, it's going to be sooner than 120. But for everything that's been issued for at least the last roughly 10 years, it's age 120.
I guess that makes me really, really old that I may or may not have been around to sell some of those products with the maturity at age 100 and age 90.
Well, you don't have to feel old about it. You can just feel experienced.
Seasoned.
And there are some people who would appreciate that.
Right.
So the calculation is what cash exists and what death benefit can be guaranteed up to that point. And once that calculation is made and you trigger the reduced paid up option, your death benefit drops to that level. And it is guaranteed from that point to remain in force with no future premium payments required.
Right.
Now, that's the technical sort of rollout of the reduced paid up option. Let's talk a little bit more about the practical aspect of it. Like what do people use it for?
Right.
So one of the most common examples is an individual who's been paying whole life insurance premiums for a number of years who decides for one reason or another that they don't want to make those payments anymore.
Right.
And they can look at the reduced paid up option as a way to stop paying premiums, not keep all of their current death benefit in place, but some of their current death benefit in place without any need to make future premium payments.
Right. And with I will add, with a policy that's designed the way that you and I end up designing policies most of the time, you could see years down the road when someone were to exercise their reduced paid up option, a death benefit that could be substantially larger than what they even started with as the reduced paid up death benefit. So It's not always like you have to necessarily be giving up everything, I guess, in the process.
I was just about to go there. So for dividend paying whole life insurance, where we're using the dividend option to purchase paid up additions, there's oftentimes a scenario that plays out where death benefit grows to a point where triggering the reduced paid up option ends up in a guaranteed death benefit larger than the original death benefit.
Right.
And oftentimes when somebody triggers the reduced paid up option, there will come a time later in the policy's life when the death benefit equals or exceeds whatever it was when they made that option. So for example, let's say you've got $1 million outstanding death benefit. That's the original guaranteed whole life death benefit plus the paid up additions that are on top of it. And you choose to trigger the reduced paid up option. And now your death benefit moving forward is going to be $500,000. There could very realistically be a point in the period in the future of that policy where the death benefit is $1 million or more, because when a policy goes through the reduced paid up feature, it continues to earn dividends. So it's not like triggering this option just freezes everything in place and you no longer receive some of the benefits that were customary for whole life insurance. You still earn dividends. You'll still accumulate guaranteed interest on the product for cash accumulation. So you absolutely can run into a scenario where at later dates, you will have as much or more death benefit than you had from the beginning, or even than you had when you made the elective option to trigger the reduced paid up.
Right. And the death benefit can continue to grow because of because dividends purchasing more paid up additions and over time. Okay. Are there any specific scenarios where other than just I'm really tired of paying the premium and can I stop paying the premium and using the RPU in that way? Are there any other scenarios where it could potentially benefit someone to exercise the RPU option?
For those who are looking to use whole life insurance as an income tool, retirement income, for example, reduce paid up as a triggering event to stop making premium payments and start distributing money from the policy will almost always generate the greatest amount of value for the policyholder. So instead of deciding I'm going to use the dividends to pay the premiums that are due, or I'm going to surrender some cash, what we call an offset. Look, we can finally do air quotes when we're talking and people actually see it.
And people can actually see. Yeah.
There are very few of you who might understand the significance of that, but it's been a long time. So for those scenarios, you could do it that way. But if you choose the reduced paid up option, it will almost assuredly create the greatest amount of distributable income and value moving forward. If you're using the dividends to pay the premium, or if you're using cash value to pay the premium, you're going to give up a little bit of performance. You're going to have less cash value, probably less creatable income if you choose either one of those two scenarios to move forward without having to pay premiums. If you choose reduced paid up, you do that and you will most likely generate the greatest amount of value with that whole life policy.
Right. Okay. So there are some applications outside of that just sort of normal thing. And I think that's when I say the normal thing outside of the I just am tired of paying the premiums. I think at least when I came along and was learning about whole life insurance and the mechanics of it, that's really what the RPU, the reduced paid up option, was more used for. So it was just sort of overlooked, as something that exists, but who cares? It's there. But as you and I started working together and we started really, focusing in on helping people accelerate cash value growth, understanding the RPU option and the power that it had became instrumental in understanding things. And we hope that this helped someone learn something.
Another application, just to be brief and cover this, it could be used as an alternative for somebody looking at a, for example, 10-pay whole life product. What we have to understand about that is the results are not guaranteed when we look at a scenario that's contingent on the reduced paid up feature versus a bona fide 10-pay whole life product. And here's what I mean. Let's say you buy a $1 million 10-pay whole life product.
Mhm.
You know that after 10 years, you're done. You'll be paid up and you'll be guaranteed to have that $1 million in place forever and always, provided you make those 10 equal whole life premium payments.
Right.
It's possible for us to take a different whole life chassis, so to speak. Let's say a paid up at age 100 product, layered paid up additions on top of it with the intention of triggering reduced paid up at year 10. And we might be able to either produce more outstanding death benefit or the same $1 million for less premium.
Right.
But we have to understand from the outset that this is a projected result. It's not a guaranteed result. And if we're willing to gamble, so to speak, on that projected aspect, then we might end up with more death benefit or less outlay versus the traditional 10 pay. But the 10 pay, the traditional 10 pay, will always be able to guarantee a result that this option, reduced paid up on a different style of whole life product, will not be able to guarantee. And then we kind of have to assess what's the likelihood of success here.
Right. Well, with the true 10 pay, the expense is built into it, right?
Yeah.
I mean, going back to, I don't remember which live broadcast it was where we talked about it, but or maybe it was a podcast. I get all these things confused. But we did talk about, there is always a trade-off with better guarantees. Typically, you're going to pay a price for that.
Yep.
And typically speaking, not in every situation, but most situations that you and I have looked at, the scenario you're talking about where you would pay a policy that is designed to be paid up at 100, and you pay it for 10 years and reduce pay up the policy, for lack of a better way to put it. Most of the time we see that work out better, as long as you're willing to accept the fact that it's not guaranteed.
Right.
So
right.
That's the trade-off. You have more variability or more exposure, I guess, to the dividend rate at that point.
I do want to mention briefly that the reduced paid up option is an irrevocable option. So when you trigger it, you have to be certain that this is what you want to do.
Right.
And or you have to understand that once it's done, it cannot be undone.
Right. No going back. No take backsies.
If your decision to stop making premium payments is because of some event that you feel is transient,
right,
it would be not advisable to reduce pay up the policy. Right. You may instead want to choose a surrender of cash to pay premium or a using the dividend to pay premium scenario.
Right.
If you truly believe that there will be a point in the future where you pick payments back up. Because if you do trigger reduced paid up, that means you cannot in the future make any payments to the policy, be they base premium or paid up addition elections. So the reduced paid up option is one that is irreversible, and once done, totally stops your ability to make any future payments to that policy in the future.
Right. Okay. I haven't looked at our notes at all, so I don't know if there's anything else that you need to add or want to add there.
The handy thing, if we forgot something, is that gives us something to talk about at some point in the future.
We probably will be back here in the next, maybe tomorrow or in the next couple of days. So there you go. All right. Well, if that's it, I'll go ahead and wrap it up. I'll drop in a small plug here. If you'd like to learn more about the kind of stuff we talk about, you want to learn more about whole life insurance in particular, head over to ipblive.com and read about our book, Predictable Profits, the 5 reasons that people actually want to buy whole life insurance, and check out some of the bonuses. Until next time, thanks so much, and we'll see you soon.